Now we need to talk about inventory costing methods. Now this is kind of important because, if we knew exactly what everything cost as it was going out the door, as we were selling it, it wouldn't be difficult. But the problem is that we don't always know the exact cost of a particular item that we sell. For example, if you think about Walmart, think about how many bottles of shampoo they probably sell in a day. And they might buy one case and it costs them $200. Another case costs them $150. So when they sell one bottle of shampoo to you, the customer, which value should they use? The case that costs $150 or the case that costs $200? And you really cannot today keep track of each individual shampoo bottle and the cost of each shampoo bottle. We are just technically unable to do that. Now with some items you can track those items, and we'll talk about that, and we call this specific ID. But with other items it's just too difficult for us to do this, and therefore we have to come up with an assumption. We call this an inventory costing assumption, and the assumption is, in what order do we sell the products? And one of those is the assumption that the oldest stuff that we have in our inventory will go out first, and we call this first in, first out. So a company that uses FIFO is under the assumption that their beginning inventory will be used up first, or it will be sold first before their new purchases during this time period will be sold. This is called first in, first out, or FIFO. Now the other assumption is that the last stuff that comes in will go out the door first, which means our beginning inventory basically stays with us. So these are two different approaches to talking about inventory. So we really have four different inventory costing methods. With specific identification, you know exactly the item and you know that item's cost. So there's no difficulty. When you expense the item as it's being sold, you're going to be crediting inventory, you're going to be debiting cost of goods sold, and it's for whatever you paid for it. Under first in, first out, you take a different approach. And then the other approach is LIFO. What is weighted average? Well, weighted average means you take an average of all your inventory costs. It's not difficult to do. We will get into examples of every single one of these. Now with specific ID, if you actually know the cost, then it's really not difficult for you to come about to figure out what cost of goods sold is. In this example, we have a 1 unit that's purchased for $70 on May 3rd. We have a unit that's purchased for $75 on May 5th. And on May 6th, we have another, and all these are identical units that is purchased for $95. Now on May 8th, we're going to sell 2 of the units, and the selling price, which is generally irrelevant when we're talking about inventory costing, by the way, is $125. If we know that the items were identified as the ones that cost $70 and $95, all we do then is take these out of inventory or credit inventory for $165 and debit cost of goods sold for $165. That is not a difficult thing to do, and it's very intuitive. On the other hand, if we don't really know which batch this particular item comes from, let's say it's a shampoo bottle and it's not something like an automobile, then we have to use conventions. And one of the conventions is first in, first out. Another one is LIFO, last in, first out. And the last one is weighted average. So if we use the FIFO method, we would say the ones which we sold were the oldest ones, because the first stuff that came in would be the stuff that would go out the door. Now I realize that this is a little confusing, the setup that your textbook has, because it's ordered the last May 6th first instead of putting May 3rd on the top. So, you know, this presentation isn't the greatest, but the first stuff in is going to go out first, and so we would be using up these two units, the $70 and the $75 costs. So our total cost would be $145 for the two items which were sold, which means in our ending inventory we would have $95 or this. Now, the reason why I mentioned goods available is that when we look at this and we see goods available, our goods available is going to consist of the May 3rd $70, the May 5th $75, and the May 6th $95. So our total goods available under FIFO is $240. And the $240 is going to be split up such that cost of goods sold gets $145 of it, and ending inventory, which shows on the balance sheet, gets the other $95. If we work under the second assumption, which is LIFO, which means the last stuff which came in goes out the door the first, then our cost of goods sold is going to come from the last merchandise we received in, these two units, and that would be 75 plus 95, or 170. Now, goods available under this LIFO is going to be the same as goods available under FIFO. It's going to be 95, 75, 70, or we said $240. So LIFO, what it does is it splits that 240 goods available differently. It says the cost should be 170 and the remaining in inventory should be 70. Notice that this plus this is 240. This plus this is 240. That is that equation that's also important to us. Under weighted average, we're going to average the cost of our merchandise that's available. Now, we said that our merchandise available was valued at $240, and we have 3 units, so that means it's $80 per unit. And if we sell 2, we record 2 times 80, or 160, as cost of goods sold, and the remainder is still in inventory, which is the 1 unit, which would be at 80. Again, 160 plus 80 is 240. So this is something that helps us. We can check our numbers. We can make sure that we have it right if we go back to that goods available equation. So, to summarize the two methods then, when we do FIFO, our cost of goods sold is the oldest cost, which means our balance sheet ends up with our newest cost. And with LIFO, cost of goods sold comes from the newest stuff we bought, and our inventory is the older stuff. The weighted average just averages everything over all the products which are sold. Now, let's consider a more complicated case here where we have a beginning inventory and we have purchases, and then we have sales and ending inventory. You notice up here it says to calculate for these, because we have to calculate. We have to use an inventory assumption to figure it out. If we sell 35 units, notice our goods available is 10 and 30, which is 40, plus 10 is 50. If we sell 35, we will have 15 left. That's pretty much a given because we know those equations. But we really don't know at this point what the cost is going to be for these units are sold, or the cost which is going to remain in ending inventory. If we were to use FIFO for this, and that would be the first one in is going to go out first, we would be looking to go back to our beginning inventory and use it up, and then use up our additional purchases in the order in which they occur to show up in cost of goods sold. So if we sell 35 units, we will use up these 10 units up here, and then we will use up 25 of these which we purchased on October 3rd, and that will be our additional amount. So now the 10 plus 25 of this group here would show up in cost of goods sold. Our ending inventory, which is 15, would be the 10 units from October 5th and the 5 units from October 3rd. And so when we calculate our cost, the total cost of goods sold will be $70. 10 times 7 is 70, plus $200, which is the 25 units here times the 8. And our ending inventory is going to consist of 10 units at $10 and the remaining 5 units at $8 for the other 40. So we end up with an ending inventory of 140 and our cost of goods sold of 270. Now this says cost of goods available for sale. We've been calling this goods available for sale, so I realize this is a little confusing terminology. This is just goods available for sale. This is the FIFO approach. So under FIFO, we figured out this number was 140 and this number is 270. If we use LIFO, we're going to do this a little bit different. This setup is the same as on the previous slide, and when we start talking about LIFO, we're going to say the last units we get in are going to be the first to go out, which means you are going to use up these 10, and then you're going to use up the other 25 from this, meaning our ending inventory is going to consist of these units and 5 at $8 here. And so as we discuss over here, you're going to have 10 units at $10 or $100 and 25 units from the October 3rd purchase at $8. And so our total cost of goods sold ends up being the $200. The total cost of goods sold is $200 from October 3rd and it's $100 from October 5th. Adds up to the total of $300 because it's coming from those two batches of products. Now if 410 is again goods available, and we know that $300 is cost of goods sold, we can back into the ending inventory. But we could also go up here and see that our ending inventory is coming from the batches that are remaining. So the equation becomes very important to us. So the 10 units at 7 and 5 units at 8 make up the 110. Again, goods available will either be ending inventory or cost of goods sold, and under all the different methods, goods available will always be this same number. All we're doing is determining how much we're splitting in between these two accounts. How much are we keeping in our balance sheet and how much we're putting in our income statement. Now, if we were to do this same problem again under weighted average, we would have to determine what the average cost per unit was in goods available. Now you're going to look at this and say, well, why can't I just add 7 plus 8, which is 15, plus 10, which is 25, and divide it by 3 to come up with a number? Well, we can't do that because this needs to be weighted a little more because there are 30 units that were purchased for $8. So we have to take into account the total value of all our inventory, and we have to divide it by the number of items. So to work through this problem, we take 410, which we again said was our goods available number, and we look up here and our goods available in units again is 10 plus 30 plus 10 or 50. So it's $8.20 per unit. So you have to not average these numbers. You have to go through and you have to calculate what goods available is by totaling up the total costs over here and also totaling up these units, and divide the total of this by the total of this to get $8.20 per unit. Now, if we sell 35 units, then what you're going to see is that 35 times $8.20 is going to be the cost of goods sold. And 15 times $8.20 is going to be your ending inventory. For each accounting period, our goods available is going to change and our number of units is going to change. So this weighted average number gets calculated for every accounting period. So it doesn't stay this. It's not going to be this for any other accounting period probably. We have to go back and we have to calculate this for every accounting period to figure out what we need in this number to multiply by the number of units to determine the total value of cost of goods sold and ending inventory. So 15 times $8.20 gives us our ending inventory, and 35 times $8.20 gives us our cost of goods sold. Now, obviously, if you're doing this, you're going to have different cost of goods sold numbers. And if you have different cost of goods sold numbers, then your financial statements will be different. Your income statement's going to be different. If you have different ending inventory numbers, which we saw, then we're also going to have a balance sheet that's different. One thing here to also note, though, is if cost of goods sold changes and you have income tax is calculated on net income is changing, income tax is changing. So there's an effect here also from the fact that your taxable income or income before income tax is going to be different. So when you apply income tax to it, the income tax number changes as well. Now, what's often talked about when we talk about this then is the effects of when prices go up or when prices go down, and if you're having to pay more for inventory, how does it show up on your balance sheet? How does it show up on your income statement? Your textbook goes into this in great detail. You really don't have to memorize any of this. You just have to put it in a problem. As long as you can remember, it's first in, first out. FIFO means the old stuff is going to go out and become cost of goods sold. And LIFO means the new stuff becomes cost of goods sold. You should be able to work through this with no difficulties.